session gave Japan investors a clear change in tone. The Nikkei 225 fell 918% to 67,242.73, interrupting the rebound that had carried the market higher in the prior session. The decline matters because it came while dollar-yen was still elevated around 162.41. In other words, the weak yen support story did not disappear, but it was not enough to protect the index. Three numbers set the scene. The Nikkei dropped almost 2%. Dollar-yen rose 329%, keeping the currency close to the level where intervention risk and inflation pressure become hard to ignore. The U.S. 10-year yield rose to roughly 4.61%, which kept global rate pressure in the background for growth shares and policy-sensitive assets. The first driver was energy. The top market headline pointed to higher oil prices hurting the corporate outlook. For Japan, that is important because oil and other imported costs become more painful when the yen is weak. A weaker yen can lift overseas earnings for exporters, but it can also raise input costs and squeeze households and domestic-facing businesses. The second driver was concentration in the equity market. News that soaring AI stocks are pushing smaller companies out of the Topix index tells us that leadership is becoming narrower. That is not automatically bearish. Strong leadership can keep an index supported, but it does mean investors need to watch breadth more closely. If only a few AI-linked names carry performance while smaller domestic names weaken, the Japan trade becomes more selective. The policy backdrop is the third layer. Reports about contradictory signals from the BOJ and the government rattling bond and currency markets kept the focus on whether Japan can manage three things at once: a very weak yen, higher yields, and equity market confidence. For overseas investors, the takeaway is that Japan remains attractive, but the story is more complicated than yen weakness equals higher stocks. The same currency move that helps some exporters also increases import costs and policy risk. Higher oil prices make that trade-off sharper. Higher U.S. yields also make AI and other long-duration growth themes more sensitive. The next session has two checkpoints. First, can the Nikkei stabilize if dollar-yen stays around 162? Second, does leadership broaden beyond AI-linked winners? If the answer to both is no, investors may keep treating Japan as an opportunity, but a much more selective